Be fearful when others are greedy, and be greedy when others are fearful. That's the advice of Warren Buffett, arguably the greatest investor of our time. But that's only one of the maxims. The other one goes something along the lines of millionaires are made when the markets are down. And we've heard all these sayings, but do we know actually why that is? And why are they true? More importantly, how can you profit from a recession? In other words, how can you expand while others are contracting along with the economy? Steve Wynn, one of the richest people in the world, who owns a plethora of hotels in Las Vegas, has said that he likes to invest precisely in times of recession. While everyone is trying to cut back on their spending, Steve invests even more money in his businesses. This way, while his competitors are spending less and aren't growing, the demand for hotel experiences is not met. Steve is the only one who is investing heavily during this time, and he is the one who will get these customers. Everyone else is hiding away. When the economy rebounds, he will retain these customers and grow his business twofold when everything is back to normal. In a nutshell, this is all you need to know about how to profit massively during a recession. But this didn't help you. You want actual numbers, ones that apply to you and not to a wealthy real estate mogul like Steve Wynn. So, what are the 3 things that you can invest in when the economy is down? The first thing you should invest in is consumer staples. What are consumer staples? Well, think about the pandemic. Even though travel was restricted and people everywhere began working from home, the grocery stores were working at full capacity. People need food, medical supplies, drugs, and hygiene products to survive. These are considered consumer staples. They are the last ones to be cut from someone's budget. And this is why some famous sites like Investopedia suggest that you smash that like button just like you should if you haven't done so already. But no, in all seriousness, they suggest investing in stocks like Johnson & Johnson, Procter & Gamble, Conagra, and Walmart during a recession. They are considered defensive stocks because they tend to outperform the S&P 500 during a recession. This was true in the last 5 recessions. On top of their strong growth during tumultuous times, these stocks are relatively low risk, and many of them offer dividends to people. Those are 3-fold benefits for consumer staples. Some people even like to invest in index funds, like the Fidelity Select Consumer Staples portfolio. This way, you also get a 4th benefit, which is diversification. Speaking of index funds, that's the second place you should park your money. If you don't want to bother with fundamental and technical analysis of businesses, if you don't want to go through reams of financial statements of individual companies, then you should seriously consider investing your money into index funds. They offer a great way to mitigate risk through diversification and are perfect for investors that prefer a hands-off approach. If you don't know what you're doing, then buying individual stocks during a recession might not be the smartest idea, because the stock that was down 20% at the end of the recession could be on the path to bankruptcy in the next 3 to 5 years. If you understand financial documents from companies, then you will probably see this coming. But if you don't, you're better off with the set it and forget it method of investing. Ever since they were invented in the 60s, index funds have generally recovered during recessions. Even though individual stocks might fall within the index as a whole will rebound. And speaking of index funds, there's another type of fund you should look at if you want to make a lot of money during a recession. We're talking about dividend index funds. We all saw that during the recent recession, cash is king. When the market takes a tumble, producing cash month in and month out is of paramount importance. If you don't have the cash, you can't invest. You need money to buy food and pay for your mortgage. This is why you should never spread yourself too thin. But that's something we'll talk about in a short while. Let's get back to dividends. Dividend stocks are volatile. They are high-risk investments because you're investing in individual stocks. Sure, they offer around a 3 to 4% return on your money every year, but the stock could go under, and you could lose your entire investment in a matter of days. This is why we suggest looking into dividend index funds. For example, the Schwab US Dividend Equity ETF offers an average dividend of about 2.62%, with an expense ratio of just 0.06%. The risk level is classified as below average. This means you invest in an index fund of dividend-paying stocks. Some stocks pay a 5% dividend, some pay a 2% dividend, and some pay a 0.5% dividend. When you average them out, the average dividend yield comes out to 2.5%. That's pretty much how dividend index funds work. But instead of volatility, you get diversification. The third way you can invest your money during a recession is in individual stocks. Before we go any further, we should state that you should do your own research when investing. These are just suggestions, and when investing in individual stocks, you are exposed to a greater risk. But Warren Buffett himself has claimed that if you know what you're doing, you don't need diversification. In other words, if the fundamentals of a company are strong, doubling down might be a good idea. Here's why. Let's imagine that company X is selling for $100 per share. Its real value is $90 per share. But because of market sentiment, that stock sells higher than it should. That same market sentiment that increased the price of a $90 stock to $100 during a bull market will inevitably decrease the price of the $90 stock. We don't know what that decrease might be, but if the market is down by 20%, then that price will also be down by 20%, meaning its price is now $80. Should you buy a stock whose market price is $80, but its real price is $90? Of course you should. If you have $5,000 invested in Company X when it was selling for $100, and you invest another $5,000 when the company is selling for $80, then you'll bring your average cost to $90 per share. As we've said, because the fundamentals of the stock are strong, this stock will likely sell for $100 or higher when the market rebounds. But if you want to invest properly during a recession, you need to follow these money management and budgeting tips and take control of your financial future. Tip number 1. During a recession, the first thing you should do is build a 12 to 24 month emergency fund. As we've said, you cannot invest in the stock market and stay in the market when you need money for food and gas. Once you have a safety cushion in place, then you can move to tip number 2. Get a side hustle. Earning money through your investments is easier said than done. The real money in the stock market is made in the long term. This is why you should seek to make money now. Become an Uber driver, get a second job. Whatever you do, do something and get more money. Tip number 3. Minimizing your high interest debt can be done in certain cases. For example, if you're a long-time client of your card issuer and you make your payments on time, then asking them to lower your interest rates might be beneficial because you'll free up more cash in the process. Tip number 4. Buy in bulk and frozen. This has to do with the food you consume. If you can afford to, make sure you buy produce in bulk when they're on sale. Frozen food is a great example of what we mean. And don't go for the big brand merch. Buy the generic brands. They're just as good. Tip number 5. You might need to borrow money to make it through. And that's fine. As long as you have a good credit score, you won't overpay for the loan. See you in the next video.